Okay, the next video in this playlist and series about the top 10 reasons why we're going to have another housing crash and crisis. This will be reasons number 6 and number 5 in descending order. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate, doing these videos over the Memorial Day weekend of 2021 and during the week right after. So we're going to get through them all. Again, hope you're having a safe and pleasant holiday. Let's get into it right now. All right. The next reasons, well, again, the top 10 reasons why we'll have another housing crash and crisis. Usually these are longer videos, so play me on 1.5 speed or going forward. There you go. Last couple of videos in the series, number 10 reason was the banks, lenders, and servicers preparing for an onslaught of foreclosures and stuff. Number 9, the Mortgage Debt Relief Act is back in play a couple of years ago. What were they thinking? What are they foreseeing the future? Number 8, investors leaving the market, all like international and domestic investors. They're not paying premium pricing anymore. They're going to wait till things change. And number 7, the housing narrative, the current housing narrative, and also the government doing what they do. I guess you could say trying to control the real estate market and being very obvious about their desire to get more involved, et cetera, et cetera. That's the top, I guess you say the first 4 reasons we talked about. Now we're going to go to the next one here, which is number 6, and it's home price appreciation. That's reason number 6. Again, this is my opinion, my ideas, my thoughts, trying to put them together. As I've mentioned earlier, not one reason individually will cause problems in the housing market, but when you put them all together cumulatively, then you can see that something could drastically happen here. And a lot of this is a repetition of what happened back a little over 10 years ago. There should be no surprises here. Okay, so reason number 6, home price appreciation is out of control. We hear about it every day. Case-Shiller National Home Price Index, we talk about that on a monthly basis. They tell us what the previous bubble was in 2006. They show us the value trough in 2012 at sort of like the bottom of the market. So we are 32% home price value across the nation above the 2006 peak, which is actually 81% increase from the trough. That's pretty significant over the past number of years. We have seen double-digit value increases from the past couple months. It's expected that we'll still continue to see this for the next few months. 19 out of 20 cities in the 20-city index had double-digit year-over-year value increases. But we can't call this a housing bubble, right? That's what people are saying, going, it's different than before. It's different this time around. So even though we are 32% greater than 2006 peak, where we call that a bubble, and when we go through all the reasons why we're having a bubble, and again, bubble is not crisis and crash. All right, that's the difference. So people are like, you can't call the bubble. Well, sure as hell you can call the bubble, because look where things are at. It's got all the bubble criteria in it. All right, and we'll get to that in more videos. But the whole point is that calling it a bubble, having a huge home price appreciation is different than calling how the crash or correction or crisis will happen. So let's make sure we keep that in mind here. So I want some proof of this, so let's go. Other way. Let me go the other way here, guys. I'm sorry. Sometimes, you flip the switch the wrong way. Okay, so this is the most recent Case-Shiller, which was March data. So Case-Shiller is data that's produced, and it's usually a lag of data because of the way they calculate it. You can see that where the red circle is, we are 32% increasing over the peak. So there it is, folks, right in front of you. I go over this every time Case-Shiller releases information. This is, again, back for March 2021. You can see that the metro, so this is the top 20 index, the top 20 metros in the country. Every location in the index, the top 20, except for one, had double-digit year-over-year percent appreciation, except for Chicago, which was 9%. So they were only 1% off from being double-digit, if you can believe that. Take a look at the 10-city composite was 12.8. The 20-city was 13.3 as a whole, and of course the U.S. national was 13.2% month over month, and of course that's where we're 32% above the 2006 peak. So really, we're seeing a significant amount of increase in values in a short period of time here. So parlaying that is, you got the National Association of Realtors, NAR, that produces their monthly existing home sales report. So of course for April, which is the most recent, their information was that the median home price was up over 19% year over year, from a value of $286,800 to $341,600. That was a record high. And here we have, so it's almost like every month now we're always bettering the previous month's records. This is the 110th straight month of year-over-year gains on the existing home sale median price. So it's increasing at a rapid pace. And again, basically, it says here for the notes below, right from NAR's website. Basically, every region, there's 4 regions: Northeast, Midwest, South, and West. Every region recorded recorded price increases. This is a record high, marks 110-month year-over-year gain. So really seems to be no stopping in sight. So we just see this massive home price appreciation, which really is hard to corral. And I want to be clear here, though, too. The recovery is not due to the economy. If you do some research on this, you can see when it came out of the trough back in 2012, there was some things going on, all right? HPA, which is home price appreciation, has far outpaced wage growth. So if you start doing some analysis, looking at the internet, you can see lots of charts and information that shows that the price point or the pace of home price appreciation has been much, much faster and greater, big divergent compared to wage growth increases, all right? So it's not because the economy is so great. It's because we had a controlled inventory back in the last housing crisis. So the banks and lenders foreclosed on millions of properties, but they only trickled a small amount into the marketplace. The majority of these were sold to institutional investors behind the scenes. How are they sold? Well, yes, some of them were purchased at the foreclosure auction, but a lot of them were sold as non-performing asset pools. The banks sold them, like Bank of America, Wells Fargo. They sold these massive pools to hedge funds, institutional investors. Fannie Mae would package up all their distressed properties and loans and sell them as well too. And we're not talking 5 houses, 10 houses. We're talking $500 million worth of houses. $1 billion worth of loan balances were sold. These are big numbers, and with that comes a big number of homes. My personal experience, I'll tell you what happened here very quickly. We had an approved short sale with Bank of America. We were preparing to close. Our negotiator went to Bank of America to present them with the closing information, and Bank of America informed us that, guess what? They no longer had the loan. So they sold the loan, or the loan was somebody else had the property, had the loan. All right, well, property is still owned by the homeowner in a short sale. The point, though, is that we were ready to close, and that disappeared. We were given who they were. It was this Washington-based or like Virginia-type-based area hedge fund, and we had an approved short sale price that was agreed upon by Bank of America. And then when we contacted the hedge fund institutional investor group and said, okay, we'd like to close, we had this with Bank of America. They didn't honor Bank of America's price point, and they wanted $40,000 more for us to close this. That's what they wanted. So it's kind of like, hey, we bought the mortgage, we bought the pool, this is what we want. And they weren't actually even interested in doing a deal with us. They actually told me on the phone, they said, well, hey, do you think that you could maybe get the homeowner to do a deed in lieu of foreclosure for us? And here I'm going, okay, well, so we just do all this work, marketing, getting the client, do all the short sale negotiation processing, get a buyer ready to close, and you're not going to close. You want 40 grand more, and you want me to convince the homeowner to sign the property over to you, and we're all homeowner, buyer, real estate agents, we're all cut out of the deal and making no money here. It's not going to work that way. But so this is the crap that we had to deal with, and we'll deal with on a forthcoming basis. But you have to understand that it basically was stuff was going on behind the scenes, which essentially was messing with the retail market. So keep that in mind here, okay? So where is the inventory? It's nowhere in the retail market, okay? New home builders are dialing it back. We have the shadow inventory out there that's still kind of ambiguous. Forbearances and foreclosures in waiting based on the current policies, and the current policies are also limiting the amount of lower priced properties in the market. So therefore, home prices are still going up without having other things coming down to push prices down. Listings are down. The volume of new listings is not increasing. Less properties. We all know the inventory issue, which has created competition, which has created bidding wars, which has created the FOMO, fear of missing out, all bubble type theory, I guess you could say things that happen. More realtors than homes for sale. The amount of actual realtors are greater than realtors being your part of National Association of Realtors are greater than the number of homes for sale in the local market right now. And then when you add the overall number of real estate agents, estimated to be about 2 million across the country. There's like a less than 1-to-1 ratio of homes per agent. So it's pretty out of control here. So, and nobody seems to care about this, right? That's the thing. Now, here's the deal. If you want to know about, and I don't want to explain it here because we could talk for hours about it, there's a gentleman called Dr. Keith Juro. He's a housing columnist for Market Watch. He's got some videos out there. If you put it into YouTube, you'll find it. Okay, his sort of premise is the housing recovery illusion and how it was built on false narratives. And if you really get into it, he's going to show, like, there's some documents out there, there's some videos. He discusses the fact that during the last housing crisis, as the banks were foreclosing, they were releasing very little foreclosed property, very little REOs into the marketplace, because the more that's out there, the cheaper the properties, and I guess the slowdown of recovery. You don't get home prices back up, right? So the banks and the government are complicit in controlling where things are today. So it's not, so where we are today is because too many fingers in the pie, too many people are controlling, trying to make money and do what they want to do. So that's why we're here today. It's not because of the economy's been fantastic, that your wages grew 50% over the last 10 years. That did not happen. It's purely because of how the distressed property volume was handled and where we are today. That's exactly what it is. So if you I don't normally advocate to watch somebody else's videos, but this is one person. I don't know who he is personally. I've never met him. I never talked to him. I just read his stuff. He's got some good information, and yeah, it's a little bit dated because some of his interviews are back from 2018 and 16, whatever. But the point, though, is that when you read and listen to what he's saying, you'll go, I get it. And it really does eye-open for a lot of people here. So that's the scoop. Oh, and first of all, or not second of all, or third of all, whatever it is, if you're not already a subscriber, because most of you who are watching this video right now are not subscribers, if you could please do me the great honor, help my channel grow and smash that subscribe button. I'd really appreciate that. I'm almost at 25,000, so we're getting there, and it's a struggle. And also, if you think you're a subscriber, if you could please verify and hit the subscribe button again too, because I lose subscribers every day, every week. I see my net numbers going down, believe it or not, for reasons. Maybe I'll do a video on that one day. So please subscribe. Thank you very much. All right, next piece of information here. Let's talk about. Again, moving too quick here. Let's talk about reason number 5, which is delinquencies, forbearance, and foreclosures. And I know we all love to hear about that, and this is kind of that ambiguous piece of information as well too. So delinquencies, forbearance, foreclosures. The issue that we have is there's no real handle on the expected volume. I'll get into that to a second here, but it really is difficult to pinpoint. What's going on now is the housing narrative suffices for now. So the housing narrative is everything's okay. Mainstream media focuses on forbearance. That seems to be the statistic and number that they monitor on an almost weekly basis and talk about. And it's almost like the metric or the litmus test as to how the distressed market's going. Okay, so that's not the right number, but that's because it's not a good number, and I'll tell you about in a second. But that's what everyone seems to be focusing on. All right, the issue, just so we want to make sure, is it's cash flow for the owner. All right, if the owners could sell, they would sell. All right, the whole point is, where are they going to go? What type of money are they going to get? Can they do first and last month and etc. before they sell? So it's really a cash flow situation for the owner, not an equity situation, as some people are sort of saying here. A problem is, though, owners wait to the last minute to do something before they do take action, and maybe too late. So we're going to see a lot of that, and that'll manifest as time goes on in this process here. But if we want to look at forbearance, so basically we've had a year's worth of forbearance now, from basically March until March, or beginning of March, early April to the end of March, April. We've done 12 months of forbearance. So of course the forbearance plans were extended by 3 months, another 3 months. So really you had 12 months, an additional 3 months. All right. So we're talking June to September. We're going to see some things fall apart here. There's roughly, as of me recording the video today, about 2.2 million homeowners still in the program, any sort of forbearance programs. This is only an estimate. Why is it an estimate? Because that's what it is. If you read the fine print from the group that actually produces this information on a weekly basis, which is typically either Black Knight Financial or the Mortgage Professional MPA Mag or MBA.org, whatever it is, Mortgage Bankers Association, it's kind of considered gospel. That's what they're focusing on. And what we'll see from time to time is people will take that forbearance information and extrapolate it and basically go, well, out of the 5 or 6 million people that have been totally in forbearance, we've had exits, we've had this, we've had that, and so far there's only a certain amount of people who left the forbearance program and are delinquent, so that's the number we're going to use. And they say, hey, when they do the same math in public to the 2.2 million, that we're going to have no foreclosures. Okay, well, here's the deal here. Out of that 2.2 million, the majority have either remained or re-entered into program. So as I said, if you could sell your home and walk away, put money in your jeans and off you go, starting off fresh someplace else, you should do it. And why wouldn't you do that? The longer you wait, you chip away at your equity and you cause yourself more undue stress and things that you can't foresee and predict in the future. Okay, expires are considered wins. So what I mean by that, if I'm in a 12-month forbearance program and I expire yesterday, I have fallen off the peg count. So I'm no longer in a forbearance program, so therefore it looks like a win or a positive occurrence in the way the forbearance statistics are calculated, right? However, we don't know my financial situation. Am I going current on my mortgage? Am I doing a workout plan? Have I just not called up my lender to get on another extension? So that's part of the ambiguous numbers we don't know. So it was, the number was like 2.1 million, plus, a couple weeks ago, and then it went up a little bit. So you see, that's what happens. So the media jumps on, oh, this is great. Look at this, good numbers. It's great, great, great. And then, oh, we have a little uptick because now people are coming back in the program. So I can tell you that the number of new forbearance requests are down quite a bit. But the issue is that the people that are in it for a reason, because they can't cure their situation and probably have bigger financial problems like they've had over the whole year. And that's the situation they're in. So that's why these 2.2 million homeowners aren't just going to disappear overnight. All right, we got to keep that in mind here. Okay, what we also don't talk about is this 1.2 million delinquent borrowers not in any forbearance plan. And it seems to be forgotten. So that's my point. So this forbearance number is a number that we basically are focused on as a group, or as a mainstream media, whatever. But what about this 1.2 million delinquent borrowers not in any forbearance plan? Well, the number is probably larger by now. I heard it was about 1.8 million now. This is a forgotten distress segment. It's just not discussed. So these are people who are delinquent in their mortgage from 30 days to almost the day before foreclosure. So anywhere in that time frame, 90 days, serious delinquent, in foreclosure process, facing a foreclosure auction, who knows? Well, that number apparently is growing about 1.8 million. And for whatever reason, these are homeowners that are not in any forbearance program. But we don't really talk about those. So when we hear webinars and trainings and people are pontificating on this, they leave that number out. So to me, that's an issue. That's not spoken about for whatever reason, because it's not interesting, or we don't want that part of the narrative. That's there. So that's why there'll be more than what they're telling us. And so any of these 1.8 million could lose their home tomorrow, depending on where they are in the foreclosure process and cycle. Okay, it's got to be factored and considered. And realize the more delinquent, this is my experience with dealing with a lot of people, 500 plus short sales over the years, etc. The more delinquent people are on their mortgage, the harder it is. So the seriously delinquent group, the more unlikely it is to cure the problem and come out of it on a positive note. All right, it's just the way it is. The farther you get behind this, it's harder to climb out. It's just the way it works. So please remember, there's a segment here that we just don't talk about. All right, FHA loan delinquencies. I talk about this every month when it comes out. FHA loan delinquencies are a higher delinquency rate than any other loan out there. They also have a greater seriously delinquency rate, and the serious delinquency rate is 90 days or greater. Okay, I consider FHA subprime 2.0, reason being because they allow low credit score, 620 credit score to get in. They allow for a much greater debt-to-income ratio than a conventional loan, so greater than 43%, and a lot of them are over 50% as well too. They also allow for a low down payment, so that's the beauty of the loan. It's going to be government-backed, and you can put 3.5% down, which is kind of interesting. And maybe you can get some seller concessions as well too at closing costs, or for closing costs at closing. So there's a lot of benefits to an FHA loan. And again, what I'm saying is that if you can get it, good for you. But realize that as we go forward with more FHA loans, they are riskier compared to all the other loan segments out there. And this is proof. So it's not like I'm making this up or hammering a certain segment of the population. If you can utilize it, good for you. Great. But realize that, I think we have to realize that it does come with a higher average risk for the marketplace. All right. Why? Because they show us this. Okay. They show us the 10 most threatened metro list. They show us the heat code zip maps and zip code heat maps. And many zip codes have over 20% of the FHA loans in that zip code delinquent. So, the proof is in the numbers here. It's not like we're just sort of suggesting this. It's actually proof in the numbers. So this is put out every month by Fannie, by FHA. And if you can look at this, but the most recent information is March's number. So the percent of FHA loans that are delinquent across the entire nation, if over 15%. The seriously delinquent is 11.5%. So that's a significant amount of people that are in a situation with their mortgage. If we go even deeper here, well, they also produce the top 10 most threatened metros based on FHA delinquency rates. This is, again, the most recent information through the end of March. How the top 10 is calculated is number of delinquent loans, seriously delinquent, and a couple other statistics, one being the number of share of FHA loan share of metro lending in 2019. What that really means is the right-hand column. That means the number of loans that were originated recently, being 2019, that are already in delinquency status. Okay, what's our top 10 list here? The Atlanta Metro, the Houston Metro, the Chicago Metro, the Washington Metro, Dallas Metro, Riverside San Bernardino Metro, Baltimore Metro, San Antonio Metro, Orlando Kissimmee Metro. And this one actually, Fort Worth, Arlington just popped up. I don't know why that's not considered the Dallas Metro, but I guess they separate. And the Fort Worth popped up, it knocked out Tampa, St. Petersburg, Clearwater, where I'm at, Metro. So really, if you take a look at this, you've got basically, about almost 1.2 million delinquent loans that are FHA. In these top 10 metros, the delinquency rate is actually 18%. And when you start taking a look at some of the total delinquencies, I mean, there was a little bit of shift in March here, but I can, if I expand this out to show the 169 metros, you're going to see some locations that have over 20% delinquent. All right, that to me, that's problematic as far as I'm concerned with respect to loan situations. This is one of the heat maps, so I can just take it. This is the Miami area. So Miami, actually in this case, their metro consists of Miami-Dade County, Broward County, and Palm Beach County. So it certainly is the southeast corner of Florida there. So this was, take a look at, so the darker the blue is the more concentrated default rate. So look, here's the zip code at the top, 23.3% rate. So certainly there is, you can see that certain, a lot of it is dark blue, all right? Simple as that in these metros. Now, if I go to the next slide here, which is interesting, you're going to see that this is the share of mortgages in that zip code that have a greater than 43% debt to income ratio. So in this case, this one zip code probably looks like it's going to be in Broward County, has 53% of the loan counts there have a greater than 43% debt to income ratio. So it kind of shows that, where we're seeing locations of distress, maybe if we take a look at where the distress came from, as part of it is how the loan products have been administered or who's utilized them, whatever. So the point is, there's a lot of factors into this, but when you look at in statistics and maps and whatever, it seems to make sense. And also, we talk about people lingering in forbearance. You could see that. The lower the credit score, the higher, the amount of people in forbearance. Okay, that's what the chart says. Your homeowners with a credit score below 660 have been more likely to remain in pandemic-era programs that allow them to miss payments. So it seems to make sense. If you're only putting 3.5% down, maybe you don't have the cash reserves to handle a few extra payments here and there. So it becomes a fact of, how much risk factor are we playing here, guys. All right. So reason number 5, we're moving on, still within reason number 5 here. It's the foreclosure part. Foreclosure starts, process, and completion. Foreclosure stats are historically low. Why is that? It's due to COVID. So when we look at information that's produced out there, some journalists or some reports talk about, foreclosures at record lows. Yeah, because nothing's being foreclosed on, or the volume over the past year was a trickle due to COVID-19, due to various moratoria across the country, due to lenders not processing the foreclosure starts, or even people that were in the process of foreclosure, due to the courts not processing them as well too. So the foreclosure information that we see on a monthly, quarterly basis is misleading because it's not a normal marketplace here. And sometimes this is also discussed as another win. So look, we have record low foreclosures and record low and record high housing prices. So therefore, it's a perfect match. Nothing's going to happen. Well, you got to understand that we have a whole ton of shadow inventory pre-foreclosures behind the scenes waiting to erupt. All right, and that no one's contemplating that. No one mainstream wise is putting a number to that, etc. So it's all ambiguous, and as long as we don't talk about it, it doesn't exist. That's how I think things are being portrayed here. So if we look at this a bit deeper, because that's what I like to do. All right, things are opening up. So in various states, we now see things changing because it's been over a year. a lot more vaccines out there. States are opening up, etc. So foreclosure auctions that are being scheduled are increasing. Okay, foreclosure starts, they're increasing. I think last one of my videos, a couple of videos ago, I talked about 24 states. In March or whatever it was, or April, the quarter increased foreclosure starts. Okay, the foreclosure cases that were kind of in sort of process but were falling in limbo, they're going to get back on track now. Okay, and so the foreclosures, and what I mean by that is it's the foreclosures and the pre-foreclosures, the whole entire segment is picking steam up now. So we're going to see more of it starting to happen, clear up the backlog even before the volume comes at us with the stuff that's going to happen in the very near future. All right, so we're going to see a steady growth of this right now. For example, this is a screenshot of the foreclosure auction calendar for Miami-Dade County for June. So there's 175 foreclosures that are auctions that are scheduled. That's the blue, and the sort of yellowy orange there. There's about 50 tax deed auctions that are scheduled. So that's so it's not like there's 5 or 10 or 25. There's 175. Now Miami's a big county, and that number typically is usually 300, 400, 500 on any given month. So you can see that we're down, but that's still a good amount of property. So I'm sure if you look hard enough, you can probably find a deal there. All right. It says Miami-Dade for July, actually a bit of an increase. Okay, 195 mortgage foreclosures, about only 42 tax deed foreclosures right now. But you can see that there's already an increase. And I can tell you that more July will fill up as June comes on. So a lot of times the courts will, as each day in court, as June 5th hits, or whatever it is, whatever date it is. Let me look here. Say on June 1st. Actually, no, I'm looking here. Okay, so when June, whatever. Anyway, usually it's 30 days out. So on the 6th and the 7th of June, they're going to set sales for 30 days out. So that's why the June numbers will actually increase as pay counts as the month goes on, because for July's will increase because more auctions are being assigned. That's the whole point. Long way of describing that. I do apologize here, guys. All right, take a look at Broward County. Okay, just up the road, 127 for June. But again, it shows you that stuff's kind of happening now. We're starting to see calendars fill up where we would see little numbers or no numbers. Now we're starting to see auction calendars fill up now. So things are actually happening. Oh, guess what? Zombie foreclosures increased 21% across the nation in the second quarter of 2021. So part of when we talk about foreclosures happening, a lot of the rhetoric has been, well, these are the zombie homes, the vacant homes, because there's no reason why those should be sitting around because it's not, no one's there to be evicted or whatever. So, okay, that's a point, but the other point is, they're starting to increase. So they're out there and they will continue to increase, of course. So that's happening right now. And if you go a little deeper into this, let's take a look at the top 10, zip codes with the highest number of zombies. You got Cleveland, Watertown, New York, Maple Heights, Ohio, Chicago, Illinois, Peoria, Illinois, Cleveland, Peoria. So we can see that the zombie properties start to increase. There's a correlation to the city and what's going on. If you drill down to that, but the point is, this is starting to happen. So we're seeing more things go on. These are all options for investment or homeownership. All right. So just because they're a zombie doesn't mean that you can't go after it. You can't contact the seller, try to put a deal together, try to do a short sale, try to figure something out. All right, there's always opportunity there. So this is one segment of what we could be focusing on as time goes on. Because there is inventory out there. But so in theory, all these could just go to foreclosure, and nobody gets to utilize them, which is a sad thing. So that's why we have to get our hands on these things. There's different ways of doing so. All right, reason number 5, still continuing here, is that I talk about this quite a bit, is the fact that we have so many mom and pop single family private landlords that here with trillions are serious liquidation risk. So I'm very clear here that I believe that the small landlord is the target because of this volume. Well, how many homes are there? Well, let's expand upon the slide here. I've used it before, all right, and it's a fuzzy slide because of where I picked it off a blog, but it just tells so much. So this is a chart of the investor sort of owning these single family homes. Again, single family is 1 to 4 units. Well, you can see that very small investors in a segment of 1 to 10, okay, 1 to 10 portfolio size, all right, own about 19.3 million, single-family properties, units, all right? About 88% of the market share. So why this is so important is that and I talk about this on the government involvement. So typically, if you're a landlord, and I've read somewhere that something like 75 to 80% of these properties do have a mortgage associated with them. All right, so you're a landlord, you've got financing your property, you're not being paid by your tenant for over a year now. Oh yeah, there's been some money earmarked via the stimulus packages where they've been passed, the CARES package, whatever act, whatever it is, for rental assistance, but for whatever reason you can't get at it because your tenant's not doing anything about it because it doesn't benefit them at all. Who cares, right? So to me, I look at this going, the bureaucracy is not helping you. This is the most exposed group here, and this is a group that we're not even considering. And look at the value here. So if you look at if the population of that very small investors, about 15.5. And there's a single-family properties about 19.3, so a little over a 1 point whatever of ratio, so property, whatever, person per property type of thing, right? So the whole point is that some of these landlords, they derive their livable income from their rental income. All right, it's not just extra money; it's livable money. All right, it's their income. So if they're in situations, forbearance typically doesn't cover an investment property, so that's the situation. And government programs aren't rolling out fast enough, and they're very difficult. I've tried to work on some of them for some clients. It's not the easiest thing, and there's some criteria there. So this to me is the segment that's targeted. I've mentioned this before. That's going to get hit, and again, how do you quantify that potential number? We just don't know. That's to me the wild card here. We don't know how this is going to manifest. Well, we know how it's going to manifest. We don't know how it's going to play out in the end, whether they're going to just sell, whether they're behind their mortgages, who knows, right? So this is where a lot of the chaos is going to derive from when everything starts falling apart, all right? So just how many are distressed? That's the big number here. And, I talked about this a few times before. As I mentioned, Black Knight focuses on the forbearance number. The chatter is 2 million plus, 2.2 million, the Friday before I'm talking on the video here, right? Adam Data Solutions has gone out a couple times with webinars over the past few months talking about the number of foreclosed homes available. They're looking at 2.5, was 1.8, then 2.5. They're thinking it could be 3 million plus over 2021 to 2025. That's foreclosed homes being available, being foreclosed on. Yahoo, I saw the Yahoo article today via a CNBC article. Someone was saying the 2.2 million forbearance numbers, and because most of these people are not going to come out of forbearance, and then the 1.8 million, not any forbearance program, but delinquents, we got 4 million, right? That's something to think about. The White House actually stated in February, as they were announcing the extension of the foreclosure and eviction moratoriums, that they believe that there's over 10 million adults in households that aren't paying their mortgage. Now, when I actually some information, some checking on that, 10 million adults in households, all right? So it's not 10 million, 10 million mortgages, 10 million adults live in households. So if you just do some basic math here, so 2 adults per household, that means 5 million, over 5 million people, right? Not paying the mortgage. And we know that there's probably less than 2 adults per household, what about 1.5, single, parent, single family, all these type of things here, right? Or whatever, just one owner. So the number is less than 2 adults per household. So it could be anywhere, I look, between 5 to 6.5 million minimum, right? Many people are quietly predicting 10 plus million. I've read a lot of stuff about that behind the scenes, and I'm hearing openly now on webinars and people who are, looking at the foreclosure industry and training and whatever, that they're saying 10 to 11 million people are going to be in the foreclosure process, hands down. So, so that's a lot bigger than 2.2 million. That seems to be the only focus that mainstream kind of talks about here. So that's kind of the distress level. So I look at it going, 4 million to 7 million is probably the number where we're going to be here. It could be more. As I said, there's some wild cards here that we don't know, and that's that we have to, I guess you could say, predict or prepare for. Now, again, this is the briefing from the White House that came out that clearly shows that 1 in 5 renters is behind on the rent, and just over 10 million homeowners are behind on mortgage payments. So of course they said 10 million homeowners. Research is 10 million adults live in households behind on payments. So you got to take that one with a grain of salt, but still, that's more than 2.2 million, right? That's, I guess, my point to you there. Here's the thing. As a summary to what I just said, my biggest reason for all the forbearance, delinquencies, foreclosures is the gross underestimation of the volume. So everybody is controlling the narrative, trying to control the narrative, and basically saying we're not going to have problems. This is not going to be a big number. It's not going to be like the last housing crisis, yada, yada. So that's where they're coming from. I'm coming from here going, okay, it's not going to be 2.2 million. It's probably going to be north of 5. The number is, we don't really know yet because it's a difficult number, because it's all, extrapolation, sampling, whatever. But here's the kicker. And I could not find the quote article on this for the video, but I've talked about it before in a previous video, so somewhere in the archives. But Black Knight said they are unsure what will happen after the forbearance period ends. So they spent the past year doing their mortgage monitor information weekly, but in the end, there was one little quote there, one article I read that they said, you know what? Yeah, we don't know. Like, there was once, June starts and September kind of rolls in when all these people are out of their programs, we don't know what's going to happen. And that's the situation here. So it's a very unknown number. And typically, what have we learned, or what have I learned from the past year of narratives that aren't housing related? Things are typically, the harder you push one way, it's usually 180 degrees the other way when it comes down to it. So that's why I'm saying they're pushing so hard for low numbers. We're probably going to be surprised. I'm not going to be surprised, but the mainstream will be surprised, and the Republic will be surprised with the true value of the distressed property, foreclosures, issues, etc., delinquencies when it really comes out, and we understand what's going on here. So realize that I said the issue is cash flow for the owner. Homeowners will wait till last minute to do something. It may be too late at that point. They're not going to have the flexibility they need to sell their property. They may not get the high price that they want, because again, all these high prices and equities are based on homes that have curb appeal, that are updated, that have the new features, whatever, okay? If you haven't paid your mortgage for 3 or 4 years, are you doing curb appeal to sell it? Are you putting extra cash in that you don't have because you have a cash flow process right now because you're not paying your mortgage? Probably not. And also, what happens when more properties hit the open market? So if you think today, going, "Ooh, my property on Zillow is worth $500,000." Well, so is your neighbor, so is the guy down the street, the person across the street, the person in the next neighborhood over. Well, if 5 or 6 homes in the little neighborhood come on right away, that creates competition, and for sellers, that means buyers will offer lower prices, and then price points that look so great will start to erode. And no one's even contemplating that as well, too. Buyers will offer less. Sellers will have to do what's called TTMAR, take the money and run. That's because, you can lose it, or put something in your jeans, or you can lose it all, and there you go. Equity will be eaten up the longer it takes to sell. It's the other sort of narrative misnomer we talk about, is the fact that all this equity will, guess what? If I haven't paid my mortgage for 2 or 3 years, I'm in forbearance, whatever the issues are, guess what? I'm chipping away at that equity, and then when it's time to sell, it's not like I'm going to get a reduction. No, it's not a short sale. If I'm doing a plain equity sale, it basically is, now you owe me principal, you owe me all the unpaid balances, and any sort of interest, fees, etc. on top of that. So that's how that's going to play out. And, once again, we don't talk about that because it's not interesting. It goes against the current narrative. All right, that's kind of the deal here. So it's time. Why do I say it's time? Market's at the breaking point. End of forbearance is approaching. Owners and investors need to liquidate. Foreclosure auctions are back on track. Foreclosure fines and starts are increasing. This is where to look for deals. It's pre-foreclosure stuff. There will be more available than predicted. We are not seeing the true numbers. I tell you this every video. Here's a sample of an email that I get. So I cleaned out my spam email folder the other day of hundreds of stuff, and I can tell you that and I just kept these. I just blanked out the sender, but here's the subjects that come to me. Okay, from bottom to top: training, housing market collapse strategy, foreclosure boom in your city, market crashing. We get difficult short sales approved. Help delinquent owners, loan defaults, how to do deals from home, updated foreclosure inventory in your city, loan approval, another squeeze on inventory. Banks are foreclosing on millions of families. Foreclosures, boom or bust, delinquent mortgages, foreclosure boom in your city, notice the default. So, and I cleared out 90% of this, or I just kept the ones that had I didn't repeat or whatever. So this is what comes to my email, because I'm in the real estate business. So what this shows me is that everybody and their uncle is now preparing to hit this market, pre-foreclosures, foreclosures, work on short sales, do their negotiation, Jolie. So everyone's prepping for it. So I guess that to me, not so. I guess that means a lot of people believe we're going to have issues. All right, not just me, not a couple other people doing videos here. That's the difference that I see from all this. And I talk to a lot of these people, and we all know and are preparing for what's going to happen in the next little bit here. So that's why I urge you guys to jump on this now, connect with me. I'll show you how to do this. I'll get you involved. You'll see how this will help you either get a primary or do some investing or do both. All right? Obviously, I've got the premier short sale cash connection. Won't be available much longer. It's going to go in a different format in the very near future. So if you want to get in now with the best program, best benefits at the best price, contact me now. Okay, only a few can get in, and I'm not being silly about this because I'm doing some deals with some other larger providers that want to market this with me, and it's going to be interesting how it's going to play out. Because I can tell you, like the last housing crisis, guess what? Nobody cared about short sales and foreclosures until it happened. Everybody wanted to get in on them, okay, because that's where the deals are. That's where you'll make the most money, all right? Okay, guys, so why, again, I show this slide every so often, equity in short sales, discounts in short sales, even without trying, we can do much better in the programs that we have here. That's the scoop. GetHousingData.com. Hit this website if you want to see the distressed property listings in your location. My partnership with Foreclosure.com. So go to GetHousingData.com. There's a free 7-day trial if you're interested. All right. I'll tell you about what I talked about in detail. If you want to connect with me, send me an email. So give me your cell phone. We'll book a time to call, and I can show you why you want to do this. So anyway, thanks once again for the views, likes, comments. Please share the video with your family and friends. Subscribe if you're not already a subscriber. Remember that this is going to happen. It's working its way through now. We're kind of at that inflection point, and we'll be doing another day or two, the next 2 reasons why we're going to have a housing crash and crisis. Thank you.